This setup, if executed the way I will explain to you, is a money printer and guarantees profits in the long run. You will get a full breakdown with strict rules, when to enter, when not to enter, when to close your position, entry, stop loss, and target levels. So next time it repeats, you can strike. Our focus for today will be on light crude oil futures Wednesday overnight DR sessions. We are focusing on a specific confirmation time window where we want to have a long confirmation between 4 a.m. to 4:30 a.m. The probabilities which I will share with you will not include any confirmation after that particular time window. Once the confirmation happens during that specific time window, we are dealing with 261 datasets in total where this unfolded over the past 17 years. The first thing to note is that once we get a long confirmation in that time window, the DR session held true 71% of the time in the past. Because we assume that the DR session holds true, we will check the true box and QuantX will only show historical data for true scenarios. After that, we want to identify the optimal time, retracement or price areas and lastly, a high probability target for the session. For the optimal entry time window, we will be focusing on the first mode from the left of the distribution up until the median time of max retracement. The median time of 5 a.m. marks the time where historically 50% of maximum retracements during the session happened. The first mode from the left of the distribution starts at 4:15 a.m. Therefore, the mode up until the median time is the time window we want to look for high probability entries. 4:15 to 5 a.m. is our strict entry time window and we want to bring that onto our chart. This means everything after 5 a.m. is not of interest for our time and price-based trading and no entries should be taken after. Before we move on to the retracement areas, it is important to know the statistics for a retracement back into the defining range as well. While there is an 87.3% probability to see a retracement back into the defining range, the probability of seeing a retracement back into the implied defining range is slightly lower with 79.1%, which is still very high. This already tells us that price sometimes likes to just retrace back into the defining range instead of deeper into the implied defining range before making its move. But what exact advantage does this give us? When looking at the maximum retracement distribution, we can see where the algo made its maximum retracements in the past between 4:15 to 5 a.m. Two maximum retracements stand out right here. Most of the retracements happen specifically from -0.01 to -0.2, which also covers the median max retracement of -0.2. The other one is going from -0.41 to -0.5. This area also covers the 70th percentile of max retracements at -0.5. After that, the distribution declines slowly. So when we bring this information onto our chart, the retracement area we anticipate for a high probability entry looks like this. Based on the data, we want to look only for entries inside the implied defining range. Nothing above it, as our first retracement area starts just right at the implied defining range. The last thing we want to know is where did price made its extension to under all these criteria. That way we can find a high probability target that the algo has seeked frequently. The max extension distribution is very interesting. 70% of the time price reached 2.1 standard deviations and 50% of the time 2.8 standard deviations. That are crazy numbers. Even though a lot of times price reached outstanding standard deviations way above 2, we will use this higher cluster right before the 70th percentile. It's the 1.9 to 1.99 standard deviation level, reached more than 70% historically, which makes it a very high probability target if entering in the 4:15 to 5 a.m. time window. Let's bring it onto our chart as well. With time, price and a target area now on our chart, let me summarize everything once more and show you how to enter trades under strict rules. You only want to use this approach on the light crude oil futures market only in Wednesday's overnight DR session, if a long confirmation happens between 4 a.m. to 4:30 a.m. Confirmations after that time window have different probabilities. After a long confirmation in that time window, you highlight the specific entry time window going from 4:15 a.m. to 5 a.m. No entries should be taken after 5 a.m. Inside that time window, you look for an entry in following retracement areas. The first retracement area would cover the high probability area going from -0.01 to -0.2, which is inside the implied defining range. The second one goes from -0.41 to -0.5. Your target for the session if entered is the 1.9 to 1.99 standard deviation level. If price reaches your target area before it retraces into the retracement areas, you won't take any trade. If your target of 1.9 has not been met until the overnight DR session ends at 8:30, you close your remaining position, since the target was filtered for the session only. Now the most important part, the entry criteria. If entering your first bullet in the first retracement area, enter one tick above the implied defining range and place your stop 3 ticks below the -0.2 retracement level. If stopped out, you can go for your second bullet for the session in the high probability retracement area lower inside the range. You use the same principles, one tick above the retracement area for your entry and your stop loss 3 ticks below it. Now, go on to your chart and backtest this approach. In the next videos, we will have a full backtesting session and see the results over the last years by simply using this approach. If you found this session insightful, please like the video and share it with your friends who trade oil. I would really appreciate it. Also, let me know in the comments which assets you trade and if you want more of those videos. I might drop more high probability setups for other instruments, and I hope to see you in the next video.
We're gonna take on the world.